Hey everyone, me Kevin here. Buckle up. We are going to get a lot of information from the Federal Reserve. The Federal Reserve statement comes out in 30 minutes. We are 30 minutes away, so that is an 11 a.m. PST for SEP and rate hike. I'm going to go ahead and drop that in the comments there so we have that highlight up. Folks, this is going to be a big moment. We have a lot riding on this, specifically in the stock market. There are a lot of folks who are very, very bullish on the Fed having a U-turn very soon. Hopefully, inflation starts plummeting towards the end of the year. Everything ends up rosy. The United States economy goes back to the moon, and all of our stocks go right back up. Unfortunately, the aggregate of the market doesn't necessarily seem to agree with that assessment. Because, when we look at the NASDAQ here, for example, we could see we're basically trading near lows. We're within about 8% of the bottom of the market, and that's quite unfortunate. In fact, if we look at the level where we are now and just pull it all the way back, we're looking for about a 290 level. We really traded around 290 right before the 2020 election, folks. Who was here back in 2020 when we were talking about, hey, pre-election fear, there's going to be a lot of FUD about drama over whether the election would end up getting contested or not. Hey, look, why not take this dip as an opportunity to buy the dip? At that time, right before the election, markets fell from 290 to 260 on the NASDAQ. I can't believe here we are 2 years later at the same place. Like literally nothing has happened to the NASDAQ essentially over the last 2 years. That's kind of remarkable to think about, especially in a world where we're told stocks only go up. Unfortunately, that's not true, and the Federal Reserve has a good old beating to give us. The biggest beating they're going to give us is going to have to do with, well, interest rates and their projections. Their summary of economic projections are going to be critical. And that's what we're going to pay attention to today. We're going to go ahead and pull up what the Wall Street estimates are for this summary of economic projections. And then we're going to compare those projections to my own projections. And then we're going to see what ends up actually happening. Remember, the schedule today is at 11 a.m. We will just get the statement from the Fed. So the Fed will tell us how much rates are going to get hiked by. That's either going to be 75 basis points or 100 basis points. Then we are going to get the summary of economic projections at the same time. Right now, markets are pricing in a 17% chance that we are going to get a full percentage point hike, something markets have not seen since the days of Paul Volcker back in the, basically 40 years ago. So in the early 80s. Getting a 100 basis point hike would be a large shock to the market. Not only would it be a large shock to the market, but we would expect to see a large drawdown in the stock market, at least to some degree. There is this potential argument that, if the Fed just shocks us for once, then maybe, and this is more of a fringe argument, but there's this fringe argument that, hey, if the Fed shocks us, maybe the stock market will actually go up on a 1% hike because it'll show that the Fed is serious. And it'll help rebuild their credibility that they need to get interest rates up high enough so that way we can get inflation down. There are arguments that the Federal Reserve rate has to go above the rate of inflation for us to actually see inflation go down. Inflation right now is sitting at 8.3%, and Fed funds rate is sitting at 2.25. Got a massive gap between the two. It is, however, possible that the Fed funds rate could run as high as 5%. Where inflation goes down to, say, 4.5%, and the Fed sits at 5% for a while as it continues to put the foot on inflation to bring it all the way down. That's entirely possible, and that would also be entirely painful to markets. Markets are not super enthusiastic about the idea of the Federal Reserve sitting at high and restrictive rates for long. Now, remember, the Federal Reserve for a while has been telling us, hey, we just expect that we're going to go to neutral, and then we're going to kind of hang out at neutral, right? That's sort of been this idea that we've heard from the Fed for quite a while. And unfortunately, that has changed. That has changed to, okay, well, we need to get to neutral, which is deemed to be about 2.5%. And maybe we need to go slightly above neutral. Okay, great. So in other words, what used to be, let's just get to neutral, has turned into, let's go above neutral. And now we're talking about going well above neutral, and not just getting above neutral and then you turning down, but actually potentially falling or staying there, I should say, staying at these higher elevated levels for quite some time. That's actually a specific phrase we're likely to hear from them, is quite some time. And that makes folks a little nervous. Expectations are, I'm going to show up the projected dot plot right now. It's going to take me just a moment to pull it up here. And this is going to be the projection of what is implied by the market for the projected interest rates that we're going to see from the Fed. And what we're going to do is we're going to compare the statement to this to see, well, how much the market has actually appropriately priced in. So right now, we are expecting, well, the yellow dots right here are what the Federal Reserve suggested we might see in the future. So that was their suggestion, the yellow dots. However, the market is implying that via this white line right here, that we're actually going to see these dots move up to where rates could be as high as 4.25 by the end of 2022. We do have not only the September meeting, but we have a November and December meeting coming up. And 4.25% could be achieved with 2 50 basis point hikes, one in November and one in December. So it actually wouldn't be that hard to get to 4.25. It actually wouldn't be surprising to get a 75 and a 50, and then you're at 4.5, right? So if we get that kind of projection, we could see markets a little upset about that. However, and unfortunately, markets are anticipating some form of stability to potentially slight decline through 2023. But starting in 2024, markets are already anticipating that rates will go back down to about 3.6% and then likely kind of plummet from there. So it'll be really interesting to see how the Fed aligns with these expectations. Again, markets are driven by expectations, and everybody's a little nervous about what's going to be on that summary of economic projections, especially projections relating to the unemployment rate, projections related to inflation that the Federal Reserve is going to see or expecting to see. So a lot to digest here, and that'll be coming shortly. Now, let's take a listen here into CNBC just for a moment, and I will be back in like 10 seconds. Hold on a sec. Let's turn this on.
Your timeline for the shorter term investors, you're probably going to bounce around that range and have resistance around 3,700. But, in the long term, for people that are investing for the long term, whether it's for their kids or for themselves, there is going to be volatility, but it could clear up in 6 to 8 months when we have more clarity on inflation potentially rolling over and maybe Fed changing course.
Yeah, but and we're talking about the Fed all day, and I get it, Delano, but you might have hopefully caught the top of the show. I mean, Vladimir Putin is talking about like tripling the number of soldiers in Ukraine. He's talking about nuclear war. He's talking about fighting to the death. I mean, hopefully somebody's just going to take him out, if you know what I mean. But I'm just worried about the world right now.
That's actually,
and so
the idea of taking out, what's his name, Vladimir Putin has been something that's been talked about for quite a while. And there are definitely some people out there who are like, well, kind of surprised it hasn't happened yet. Yeah. So anyway, the whole Putin thing is a whole nother disaster and nightmare, and we'll see how that evolves. It does seem like Ukraine is keeping up the fight very strongly. Not only are they strongly keeping up the fight, but also expecting to retake a lot of area, including what they just retook in Kharkiv, which was pretty incredible, following, of course, madness like news about mass graves of civilians being discovered. Really quite sad. Anyway, so focusing, though, on the Federal Reserve, big day today. We have 2 more Fed meetings this year, and 2022, just the way it is just, unfortunately, not the best year for investing. It's one of those years where it's like, yep, could have just sold in January, probably come back next January, and still been in roughly some of the same spots, which is kind of sad. But what are you going to do? So let's go ahead and pull up the summary of economic projections just to get familiar with the what we're expecting to see again. This is going to be very important because, again, it's going to dictate Fed policy. What they say here in the summary of economic projections gives us a guide of what to expect. So going forward, once we actually get this document, these are my projections and the projections that we saw in the last summary of economic projections. One of the biggest differences that we're going to be looking for today is we're actually going to also get we're actually also going to get 2025 numbers. Now that's actually pretty remarkable because so far we've only been looking at 2022, 23, and 24. And now we're actually going to get unemployment numbers for 2023, 4, and 5, which is really interesting. And we expect those numbers to come up pretty strongly for not just unemployment, but we expect higher revisions for inflation that's lasting longer, and likely a lower GDP, which puts us closer to recession. In fact, if we jump over to the Atlanta Fed GDP now chart, let's go ahead and pull this up. Let's take a look at what the Atlanta Fed is presently estimating GDP at based on their last estimate. By the way, this morning in our course member live stream, we talked about how FDIC bank balances were starting to decline. And we also did quite a bit of analysis on American Express and some of the unique features that American Express is seeing, that they are seeing, but also some risk factors that they're seeing. And how American Express potentially relates to being maybe an earnings-proof or earnings recession-proof stock. Now, obviously, there's no such thing as a company that is fully immune to risk factors in the markets. But if you're interested in those live streams, we do them every day the market is open. You can join any of the programs linked down below. Even if you don't want the course content, even though there's wonderful lifetime access to information there, you get the real estate analysis and stock analysis in our daily live streams every day. And we really try to go fundamentals, hands-on. But let's take a look at the latest estimate for the GDP now growth. It's currently estimated at 0.3%. That's pretty low. Here's your charted estimate. You could see that the stock market is pricing in a recession, according to the GDP now chart. And the Atlanta Fed chart is basically showing growth that's almost near zero and somewhat trending towards zero, which is a little nerve-wracking, obviously. But it's cause for concern because, hey, you know what? The way I look at it is we substantially overinflated our economy in 2020 and 2021 in response to this once-in-a-100-year pandemic to make sure that we wouldn't have a collapse of essentially civilization, which sounds pretty remarkable, but it could happen. And so Congress and the Fed did everything they could to stop damage. But by doing so, they overinflated us with too much cheap money. I remember at the beginning of March of 2020, I saw the Federal Reserve on a Sunday conduct an emergency meeting and drop interest rates 2%. I'll never forget that day. The very next day, I said, oh my gosh, now's the time to refinance. Like there's about to be a huge line of people trying to refinance. Let me get in early. Refinanced every property I could, threw it all into the stock market. My refinance closed like 30 days later, which ended up being like somewhere between March 23rd and April 3rd. Those were the two bottoms in the 2020 pandemic. And it's like, wow, okay, yeah, I like that. So a little bit of market timing never hurts, especially when it comes to slower moving things like real estate, which is exactly why we're trying to take advantage of the real estate crash coming up, which we invited accredited investors to househack.com to learn more about how we're raising cash to go buy real estate in the dip that we're likely to face. And has already begun in many areas. So it's quite remarkable, the real estate opportunity that'll be coming up. We are hoping to open househack.com to non-accredited investors as early as January or February. I've already retained a Reg A attorney for this process. We have to go through a little bit more SEC compliance, but we don't actually expect it to be as difficult as we thought. And it'll be a great opportunity. So stay tuned for more details on that. Of course, this isn't a solicitation. Only the PPM is on the website at househack.com. You can see that the 10-year Treasury right now is sitting at 3.57. This is actually unchanged from yesterday, which is a little bit surprising to me because this morning it was falling a little bit. Now, another thing that I think is really credible is the 2-year Treasury. The 2-year Treasury yield, just type it in Google here, 2-year Treasury yield. And honestly, you could even go down to as much as the 6-month Treasury yield. But stop, I don't want the article. I want the chart. The 2-year Treasury, look at this. It's basically at 4%. So if right now you wanted to commit money to a 2-year Treasury bond and get paid at the end of the 2-year term, the equivalent of 2 years worth of interest, if you put $1 million into this right now, you would get $1,080,000 back at the end of 2 years. It's kind of interesting, although a lot of people would argue, sure, rates are that high, but that's because there's a huge opportunity to take that $1 million, maybe buy even the S&P 500 or the NASDAQ or Tesla or invest into househack or whatever right now, and potentially instead of just returning 4% per year, return 30% per year or whatever it ends up being, right? Obviously, there's risk that comes with that. Yeah, Reg A attorney. Reg A stands for Regulation A, and it allows non-accredited and retail investors without any kind of requirement that we verify individuals' net worth and that above or income above a certain threshold. Anyway, so the 2-year Treasury yield here is quite remarkable, and this has actually led to the inverted yield curve that we've seen. The inverted yield curve is the spread between the 10-year and the 2-year. We just looked at the 10-year and we saw it was 3.57. Well, the 2-year, which is the shorter bond, the 10-year is only paying you 3.57. The 2-year is paying you 4%. Why is the shorter one paying you more? Well, again, the reason for that has to do with your opportunity cost during a recession. If you're willing to tie up money for 10 years while we're in a recession at the front end of the curve, when people see that, well, I need to be getting compensated more to lock up my money now. It's kind of weird. It's extremely weird how the bond market works, but essentially there's a desire for cash in the shorter term and a liquidity in the shorter term because there are opportunities in recessions, right? There are opportunities in real estate, there are opportunities in stocks, there are opportunities in private equity. I do hear a lot of folks say things like, "Oh, well, this is interesting." Okay, hold on. There we go. I do hear a lot of people say things like, "Oh, but Kevin, inflation kills cash." No, it doesn't. Like, inflation only hurts cash if you're spending it on food and groceries and things that are going up in price. The reality is inflation actually makes it cheaper for you to purchase assets that go down in value when the Fed fights inflation. And in this case, that would be stocks and real estate. Okay, so let's see here. Survey. Okay. FOMC updates its economic forecast this meeting. Write down your expectations for each of the following. Yep. Okay, interesting. So there are 41 responses here to what the expectations are on the SEP. So let's go ahead and update the SEP together. I think this is really neat. So what we'll do is we'll write down Kevin's projections, Kevin's estimates in red. And then we're going to do Wall Street estimates, estimates in orange. And then we'll do the reality of what the Fed comes out with. Well, it doesn't necessarily have to be reality because what the Fed says isn't necessarily reality. That'll be blue. Fed results. Okay. So let's go ahead and write those all onto here. I'm just going to go ahead and erase this. So this is 4.7 to 4.9. on the red for unemployment, 4.7 to 4.9. So we'll turn this red and make it a little smaller. So that way we can hold me accountable, my estimates versus what we actually end up getting, right? So we'll put that right about there. So I gave a projection over here of the Fed funds rate of 3.8 to 3.9%. Okay, so let's go ahead and change this, 3.8 to 3.9. Drop that in here, 3.8 to 3.9. And then we're going to write down the Wall Street estimates as well, and then we'll be able to compare. Keep in mind, if you want to see, if you just came from the Donald Trump video that I posted, breaking down the new Trump lawsuit, the PDF is live that I mentioned would be live. It's totally free. You can download it by going to metkevin.com/links. In fact, if you want links for anything that I mentioned, you could just go to metkevin.com/links, and you'll see links there for life insurance, free stocks with Webull, househack links. Like if you want to read our PPM, you want to see the introduction video to what is househack, whatever, all of those things are available there. Just go to metkevin.com/links. We made it a nice and easy single spot location for you to get everything. And this video is brought to you by StreamYard, metkevin.com/StreamYard. Okay. So these in red here are my estimates, and I'm expecting that 3.9 U-turn over here, 3.9. There we go. Now let's go ahead and put in the Wall Street estimates. So this will be fun as well. And then of course we'll compare to the Fed. So these are the Kevin estimates right here. That's sort of what I think the Fed is going to do. And in terms of PCE inflation, before I get spoiled, why don't I just go ahead and put down, I think we're going to see PCE inflation from the Fed probably closer to 6.2. And then for the next year, I'll put it at 4.8%. Those are going to be my estimates for these two items here, for these 2 years. I'm not going to necessarily estimate everything here. So, but what I am going to do now is we're going to do Wall Street. So we're going to do Wall Street in orange. This is based on 40, what do we got here? 41 surveys. We have this is the unemployment rate. Unemployment rate, according to Wall Street in 2023, we expect the Federal Reserve to come in with a 4.1% and then 4.2 next year. Interesting. All right, let's go ahead and drop that right here. So Wall Street thinks 4.1. And does it let me copy and paste? Because that would make this a lot easier. Oh, it does. There we go. Oh, that's weird. It puts it in a weird spot. All right, let's move that. Get rid of that. Delete. There we go. Okay, and then next year for 2024, they're estimating 4.2. Interesting. I actually think a much higher unemployment rate. So they're coming in way lower than me with that unemployment rate. I mean, hey, maybe not. And the Fed thinks unemployment's going to be very, very strong. So maybe they too will come in with a relatively soft unemployment report. Then we have the inflation projection. Wow, they think they think the Fed is going to come in with actually they think the Fed's going to keep it at 5.2. Really? I don't know. I don't know about that. I don't know about that at all. 5.2, and then all the way down to 2.6 in 2023. I don't see it. I don't see it going down that low. If the Fed says that, I don't know. I don't know what they're smoking, but okay. Fed funds rate, 4.1 in 2023. Interesting. Wall Street is a lot more conservative here than I am. Now, I actually think that's dangerous because if we surprise to the upper side, it's going to be a problem. 4.1 and then 3.6. Wow. Wall Street definitely thinks the Fed's going to be a lot more dovish than Kevin does. All right, that's fine. I really wish the Fed would come out with something a little bit more hawkish just to stop revising these estimates. Like every one of their estimates so far has been terribly wrong. So, I mean, we'll see. We will see. Current Fed balance sheet is sitting at 8.8 trillion. Expectation is, let's see here. Do you expect the Fed to sell mortgage-backed security holdings? That could increase interest rates for mortgages. 50-50 on that for responses. This is just a Wall Street survey by Bloomberg here. All right, interesting. Okay, so those are some of the projections that we have right now. We are now on standby for the actual results, which come out in about 5 minutes. We are 5 minutes away now from getting the results from good old J. Powell and the Federal Reserve. Jerome Powell will be speaking to us at 11:30. However, we will have 30 minutes to go over the summary of economic projections. A chief investment officer over at Cap Trust said the market is expecting Powell to be in full hawk mode. So anything less than hawkish, I think, will be met with a big market rally. I don't know if I necessarily agree with that. If these are the Wall Street expectations, these seem like pretty dovish Wall Street expectations in orange here. I don't know. But then again, if we were to jump on over to what's going on over at Webull, and we just sort of like actually look at the market here. Remember, you could get 12 free stocks with Webull by going to metkevin.com/Webull. When we actually look over here, it's like, I don't know. I mean, QQQ's up 0.2%. Tesla's only up 0.1%. Bitcoin's up 3%. Okay, so maybe like a tiny little bit of optimism here, but I don't know if that's just misplaced hope. I mean, Open Door is down another 3%, but that doesn't surprise me because I think Open Door is going to go bankrupt. I don't know if this was actually true, but I saw this, somebody sent me this thread on Reddit, and they're like, oh, look at this Open Door co-founder freaking out on Twitter, calling people morons for shorting the stock and saying they're fine. And I look at the thread, I'm like, man, I don't blame people for shorting Open Door. I said that like 2 days ago too. It's like, they got like $6.6 billion in houses on the books based on Q1 and Q2 valuations. But they've got like $6.6 billion in debt, half of that current, half of that long-term. So they're basically 100% leveraged on $6.6 billion in flips. Dude, if they take a 20% write-down, they're upside down by $1.2 billion. They have to go to the stock market and raise money or the bond market to raise money. Otherwise, they go BK. Now, I don't actually think they're going to go bankrupt. But I mean, like, I don't want their balance sheet right now. That's terrible. This is why, and people ask me this about househack, and I want to say this because it's very, very important. I believe the time to buy real estate, which is what we're going to do. We're building the war chest. This is why people who are sending us hundreds of thousands of dollars to invest with us, accredited investors at househack.com, people know that we're going to wait until the timing is right in each market. And that could be different for various different markets. But I believe the likelihood is when we actually start seeing mortgage rates peak and then start coming down in conjunction with the Federal Reserve U-turn, real estate pain will actually probably still continue for about a year, but it's going to mark the trough. And that's where you want to go shopping. You want to shop in the trough. Like there's no, I think some people sometimes have this impression that when it comes to timing the market, you have to be some, crystal ball genius to time the market and that you need to perfectly exit a position here and enter the position here, right? I think that's the expectation people have when you hear time the market, but that's actually not what you need to do at all. Generally, my expectation in a market is that you want to be a seller when you're at this part of a cycle. This was sort of very similar to November of 2021. And if you go back to my videos in 2021, a lot of people called me a fudster and a loser for saying that this is a little unsustainable, and it was a lot unsustainable. You should probably sell a little bit, even if you're like, okay, 10% sell here, 10% sell there, 10% there, and maybe even consider having some hedges to the downside. I wish I went full on hedge to the downside, but then again, hindsight is 2020. But the point is, you sell a little bit at the top and you buy in the buying trough. That's generally what I view as buying the market or buying timing the market, right? Whereas dollar cost averaging is just doing this. Buy, right? So that's dollar cost average versus sort of a more macro method for timing market purchases. Just sort of my thesis. But anyway, let's go ahead and prepare now for the information to come out from the Federal Reserve. Again, we are expecting a 75 basis point hike. And the most important thing that we're looking for right now is that summary of economic projections, folks. Summary of economic projections. That is going to be critical. And so we're going to try to get that here as soon as humanly possible. Okay, we are 30 seconds away. That sounds like Age of Empires. All right. Big moment. All right, 15 seconds. Woo! Thank you for the donations, $10, $5. Thank you so much. Come on, baby. Come on. Here we go. All right, refreshing. What do we got? Come on. It's not out yet. It's not out yet. Median forecast shows rates at 4.6 in 2023, 3.9 in 2024. That's higher than expected. That's definitely higher than expected. Fed repeats it, anticipates ongoing rate hikes are appropriate. Come on, like what's the statement still not out? Here it is. I got the statement. In support of these goals, the committee decided to raise the target rate to 3 to 3.25%. That's 3 quarters. We got 3 quarters. So we got the 75 basis point hike we were expecting, but that forecast is bad so far. I don't, this must be computer generated so far, this forecast, but that forecast, look at what it was. Okay. So look at the projected rate here on the bottom, Fed funds rate by 2024. I was expecting 3.9. The market was expecting by 2023. By 2023, I was expecting 4.4 to 4.6. The Fed just came in with a dirty number. Oh, man. The Fed actually came in with 4.6 right here. So I was right on the upper end here. Finally, the Fed's putting some pants on. Stocks turning negative right now. The Fed anticipates that ongoing increases in the target range will be appropriate. No sign of any relaxation. We got the 75 basis points, but we're also coming in at the high end here. For 2024, the Fed, holy shit, I'm good. Damn, Kevin, holy crap. Comes in at 3.9. Wall Street, terribly wrong. Kevin nailed it on the Fed FO. You saw that happen live, okay? That's cool. Like there's no hindsight bias in that. You saw me come up with that live. Fed now sees the terminal rate of the hiking cycle at 4.6, up from 3.8 in the last dot plot. That's a reference to right here. Okay, that's bad. That terminal rate. Still waiting for the actual SEP doc, but I am getting the data coming through. That's about another 125 basis points of hikes spread out over probably the November and December meetings. So for us to achieve this, we're basically now pricing in, write this down, pricing in now 75 in November and 50 in December. Okay. Highly attentive to inflation risks. The language in the statement hasn't changed with regard to inflation remaining elevated. Still waiting for the actual summary of economic projections, but we do have the actual data coming in. Oh, whoa! The 2-year Treasury yield just jumped to 4.11. Oh, man. Okay, let me take a look here. I want to see what's going on with the 10-year too. That's bad for real estate, folks. But hey, what's bad for real estate is good for househack because we're going to get some better deals. I know that sounds terrible because it basically means I'm expecting home prices to fall. But let me be crystal clear. I've been talking about home prices falling since January, okay? Like, I've given plenty of warnings. Anyway, take a look at this, folks. Holy crap. The 3.6 on the 10-year Treasury right now, absolute devastation. 4.15 on the 2-year. This is insane. Stock market now down 0.5%. Look at that plummet on the QQQ. Tesla almost down 1%. This is terrible, especially for real estate stocks. Open door down now 5 percentage points. Look, I hate to say that I came in hot on the expectations for that summary of economic projections. I ended up being right on my expectations for that, but I have to say, like, this is what's needed. The Fed should have put on the big boy pants in June. They didn't, and then we got a 9.1% report, and now they're finally putting on the big boy pants, and they're like, yeah, no, okay, we need to go. Okay, there we go. I have the actual SEP now, and so let me airdrop that over. But I've already been reading off the SEP because I have another source for it. I just want the actual PDF. Okay. All right. So here comes the new SEP. Woo! Oh, come on, man. I don't know. I'm just really proud of myself. Again, it's sad, but I can't help it. But look, my estimate was in red. Okay, 4.6% and 3.9. Okay. Then we jump on over to the new table. What did we get, folks? What did we get? And the calendar has moved over one because they added a new year, 2025. 3.6 and 3.9. Come on, man. Nobody covers the Fed better than us here. Thank you for watching. Okay, let's see what we got. Holy crap. Look at the change in GDP. Oh my gosh, this is terrible. 2 for GDP. Finally, the Fed puts on the big boy pants and admits that we're basically close to a recession. Finally, they admit it. Finally. Now, they actually think GDP is going to go up to 1.2 and 1.7% in 2023 and 2024, but they have completely crushed their expectation of what GDP would be doing. They told us in June, oh, don't worry, we'll be far away from a recession with nearly a 2% GDP. Wrong. 0.2% is the current expectation, basically teetering on recession. And we are already technically in a recession. However, GDP could be revised up, right? But that is a huge revision to the downside on GDP expectations. Okay, let's look at the unemployment rate. So the unemployment rate did not rise as much in the Fed's view, did not rise as much as Kevin projected. Kevin projected on an unemployment rate that we would actually see an estimate of 6.2 in 2020 in 2022, and then 2023 4.8. So I was clearly very high on how quickly the unemployment rate would go up. So I wasn't as good on the unemployment rate. The Fed keeps the unemployment rate over here at definitely a move up, but not until 2023. And they see the unemployment rate rising only by about 0.5%. I expect that this is going to get creamed in the future. I don't think that'll last. I think we'll probably be seeing 5%, but that's okay. The Fed actually projects that inflation will stay around 5% by the end of the year, but remarkably thinks that inflation will actually go down to 2.8% next year. Okay. All right. I don't know about that. But the big killer here, folks, is the projected path for the federal funds rate. This is everything. We got a 75 BP hike. That's not a big deal. We were expecting 75 basis points. The big deal here is that the Federal Reserve put on their big boy pants and finally said, sorry, folks, we are going to go not just above neutral anymore. Remember what the neutral rate is. The neutral rate is 2.5%. Jerome Powell told us we would go to neutral, maybe slightly above. Okay, this is now 2.1% above before we actually peak. And no guidance in terms of when we'll actually come down, just that it'll be hopefully by 2024. Now, what I do want to look at is the ranges, okay? Look at this, folks. Look at the range. So central tendency and range. Okay, so central tendency is more of an average. I want to look at the range here. So the range for hikes shows that almost everyone at the Federal Reserve believes that rates are going to go to 4% or above as a terminal rate for the Fed. This could be one member saying 3.9%. And we'll look at the dot plots in a moment to see that range and see clearly what's going on there. But that's interesting to me, is that the Fed is very unified here in this approach that, we need the terminal rate to go above 4%. I don't know. Let me see if there was any dissension on the actual FOMC statement on the vote to go 75. Voting for were Powell, Williams, Barr, Bowman, Brainard, Bullard, Collins, Cook, George, Jefferson, Mester, Waller. All 12. It was unanimous. All 12 board members said 75. Yesterday, the Wall Street Journal, and I read the newspaper, okay? I read the live stuff that we see on the internet, but I also read the newspaper. And in the newspaper, the Wall Street Journal would kind of put a thing up, and they're like, this is how the FOMC statement could change. They actually thought that 2 board members were going to vote no to 75 and go for 50. Wrong. Every single Fed board member went for 75 on this one. Big deal. Okay? Now, let's go ahead and look at the ranges, but I'm getting a lot of comments here from members on the channel. Thank you, by the way, for being a channel member. It really helps us cut down on spam in these comments. I can actually look at them and read them and not have to worry and get distracted about spam. I'm getting a lot of comments from folks asking that we look at BTC. It looks like BTC was just a little volatile here. I mean, kind of went back to about a 19,000 level, roughly kind of what you would expect because that's where we were teetering yesterday. We did rally a bit up to about almost 20,000, that 19.8 level. But we are seeing somewhat of a little bit of a recovery right now in the stock market. This kind of damage could quickly get undone when Jerome Powell actually goes to speak. DXY just shot up to 111. That's insane. But it makes sense. Oh my gosh. Yeah. So this makes sense because as interest rates for risk-free money skyrocket in America, oh my gosh, yeah, the dollar skyrocketing. The dollar strengthens because remember, when you offer 4% risk-free, and look, I'm becoming a licensed financial advisor. As far as I'm aware, the only thing that you are allowed to call risk-free are treasury bonds and notes, right? That's it. And, when the international community can look at the 10-year treasury at 3.6%, or a 5-year treasury at now 4.1%, that's pretty awesome. That's like a pretty nice yield. So what do? You buy dollars. When you buy dollars, you sell your country's currency. So if you own euros, you're like, dump this crap, I'm buying dollars. And that's how you get to the euro being worth less than $1 now. And then people can buy bonds, or corporations can buy bonds in America. It's quite incredible. So this pushes up. Okay, so remember, the Federal Reserve Fed funds rate does not directly correlate to what interest rates are on mortgage rates or the 10-year treasury. The Fed funds rate is the rate that banks, under the sort of supervision of the Federal Reserve, lend money to each other on an overnight rate. That's different from the discount window where you can borrow from the Fed. And that rate affects a lot of things: credit cards, car loans, mortgages, everything. But it's not a one-for-one move because the market actually prices treasury yields. And the market tries to anticipate what the Federal Reserve is going to do. And so when we get kind of a little bit of a rug pull here, okay, a little bit of a rug pull on that rate move, but it was necessary, okay? Look again at the projections. So look at the projections here. What do we got? These are the projections for the FOMC. Kevin is in red. The Fed and what we actually got is in blue. And Wall Street expectations are in orange. And you can see Wall Street did not think the Fed was going to put on their big boy pants. Wall Street thought we were going to be sitting at, 4.1% for the peak Fed funds rate, and then 3%, 3.6% thereafter. Sorry, we beat that. Finally. Welcome aboard, new members. Car for Coin. Efrain, thank you so much for joining. Government won't be able to service their debt soon. This is untrue. So if you actually look at the, here, let's look it up. Centless Fed, debt payments, debt service payments, United States. So we're going to pull this chart up. And we're going to look at interest payments as a percentage of GDP for the United States. And what's really interesting about this is, yeah, we've had depressed periods because interest rates have been low, of paying low rates for our debt. But actually, if you look at this, what you see is that back in the 90s, the late 80s, mid to late 80s and early 90s, we actually paid closer to 3.25% of our GDP in interest. At the end of 2021, that was just 1.5%. So we could actually double our interest payments and still be at levels that we were in the 90s. So what's remarkable about that also, though, is that the federal debt does not renew instantly. It's not like every single debt payment the federal government has is now more expensive. It's only when they roll off that and these interest rates adjust that the debt becomes more expensive. So it's not necessary to think that all of a sudden all of these interest expenses go higher. They don't. So that's an important note. All right. So let's see what else we have here. We can look at, oh, good. We have a little highlighting here of the statement and what changed in the last statement. Shout out to CNBC for throwing this together. That is definitely the wrong button. This button. So the current statement says, recent indicators point to modest growth in spending and production. Job gains have been robust. That's interesting. So they actually got rid of this idea that spending has softened. And they actually went back to this idea that no, spending's not softening. We're actually seeing a strengthening of spending. Now, keep in mind, Jerome Powell is going to be speaking in 15 minutes, so we're going to keep that, keep an eye on that. And then, of course, this is where we see the 75 basis point hike. Otherwise, the statement really hasn't been changed at all. But it is interesting to see the Fed say, hey, we're seeing some modest growth in spending. That's actually really an important change, because when we see this modest change in spending, and it's to the upside, then that is another signal to the Fed that they need to crimp down more, right? So modest growth in spending and production is the new phrase from spending and production have softened. That was the old phrase. So that is a phraseology change, phrase change. We did get again, as a recap, we got the 75 BP hike. Wall Street was expecting 2 dissenters. We actually got 0 dissenters. We got a unanimous approach, just sort of as a quick recap. In addition to that, we had a Wall Street expected Wall Street cap of 4.1% for the terminal rate. We actually got the higher end of Kevin's estimate, 4.6%. That's why we're seeing the red for 2023. And then for 2024, we saw the Fed, going back to the statement, we saw the Fed come in with 3.9, which was exactly my estimate. 3.9%, exactly Kevin's estimate, versus 3.6 for Wall Street's expectation for 2024. So kind of just writing a quick little note on that. Okay, let's now go over to the plots again, and let's take a look at what some of the ranges are that we got. And we can do that by looking at the dot plots. So let's go. This is the dot plot. So these are the rate projections. Yeah, look at that, folks. Only one person, only one dot, thinks that rates are actually going to be under 4% at the terminal level. That's a big deal. Only one person is assuming that. Everyone else is sitting between 3.375 and 4.875. Okay, that's a mouthful. I'm gonna write that down with you so you can kind of see what that looks like. Dot plots, because it's a little complicated what I just said. Okay, so we'll do it together right here. So only one Fed member thinks rates will be below 4% in 2023. All other 11 believe the rates will be between 4.375 and 4.875 in 2023. And then this is the dot plot, right? Dot plot. Very interesting. And that's equal distribution between those three as well. You could see that equal distribution when I just hop on over here. You can see that very, very equal distribution there. And the reason I used eighths there is because you could see these dots are actually appearing between the lines, and the lines are quarters, and between the lines are eighths. So that's why I wrote that as eighths, which is like a 3.75 or a 4.375, right? That's an eighth. So it's 3/8, right? Anyway, so then you get a lot of diversity here in 2024 of opinion. Look at this. There's really no theme here in the opinion for 2024. And actually what that signals to me is a lot of uncertainty at the Fed. It shows that even though there's how would you say that? Unanimousness? Even though there's unanimousness right now in rates going to a terminal rate of above 4%, we do not have that in 2024. So that's another little note. Like if you're taking notes on this to take away, there is no consistency or unanimous agreement on where rates should be in 2024. And what that really says is we have a lot of uncertainty that is still to be priced into the market. Uncertainty leads to volatility in markets, right? And that means less clear stock market rallies, less clear interest rate paths, and also a less clear real estate path. Really, we believe that over at househack, we believe that real estate prices are already well past peak and that they're likely to bottom about a year after the Federal Reserve U-turns. However, that U-turn may not, may not happen as soon as we think. Now, I do just want to, again, explain that if you are an accredited investor, you can invest today. You could just upload your W-2s, get a letter from investready.com or your tax returns, any of those, verify you're an accredited investor, and you can invest with us immediately. You get founder shares in this company, which is very, very rare, but I'm doing that as a way to grow with my subscribers. I want to look back in 5 years and be able to say, I raised money with my subscribers and they handsomely profited. So that way in the future, if we ever want to do a deal again together, you're like, yeah, I want to do a deal with Kevin. Like it's so important for my reputation that this does well. Obviously, I can't guarantee that this does well, but that's my expectation and my hope. Anyway, so if you're accredited, you're welcome to check it out. If you're not accredited and you're excited to get in on househack, I have retained a Regulation A attorney who would enable us to do this. And it's actually a lot less expensive than I thought. It's just a little bit arduous in terms of what we have to do, but we're going to make sure we can make that happen. It just takes time. That's going to be an SEC registered offering, and that's going to take 5 or 6 months or so. We'll see if it can be expedited, but we'll do our best. So now what we're waiting for is a Federal Reserve Chairperson Jerome Powell's press conference. That press conference is going to begin in about 8 minutes, right? So we're going to go ahead and write down here that 11:30 Pacific, Jerome Powell speaks. Okay, so, we have this question here that says, why is everything selling off when the market got exactly what it expected? Well, your answer is actually very, very simple. The market was not concerned about whether or not we were going to get a 75 basis point hike. That was not the concern. The concern was actually what the summary of economic projections would say. And the summary of economic projections, unfortunately, gave us a disaster. They gave us a terminal federal funds rate that was substantially higher than markets anticipated. Markets were expecting the terminal Fed funds rate would be about 4.1%. It actually came in line with the upper end of my personal estimate of 4.6%. Finally, the Fed is putting on the pants and saying, no, we're going to deal with this. This is actually a good thing because it means the Fed is quite frankly being honest with us. Whereas in the past, they haven't been that accurate. I want to remind you of how terribly inaccurate their projections have been in the past. Their FOMC statement in December, for example, was a complete disaster. And when they had to U-turn on that, it became clear that the Federal Reserve had as little clue of what was to come as we did. We were all quite blindsided, quite frankly. And so that's bad, right? When we're blindsided, we end up seeing markets adjust and fall. So, for example, if I go to the December 2021, I want you to see this, okay? December of 2021, I have it right here. This is the Fed statement, December of 2021. The Federal Reserve projected that at the end of 2022, the federal funds rate would be 0.9% in green, and that it would go to 2.1% only in 2024, folks. Well, what ended up happening? We ended up getting a Fed funds rate that is expected to go to 4.6% next year. That's more than 3 percentage points higher. And the Fed came in with a terrible GDP projection. Yikes. Yikes, yikes, yikes. Is househack going to pay dividends? It's a good question. This is a growth company. It's not starting as a REIT. And the answer initially is going to be no. We will probably outline some form of dividend plan in the future, but right now the goal is to get to IPO with househack. I receive no compensation, no bonuses, nothing unless we IPO househack and the original investors in the company get a double on their money. That's our current, and we're finalizing that stock comp plan. But basically, myself, my wife, we get paid nothing until this company IPOs and the original investors have doubled their money. And really, we hope that would be like a minimum, right? But we can't guarantee that. But anyway, learn more, obviously, by going over to househack.com. All right. So let's see here. We have 5 minutes to go before Jerome Powell comes. Fed was basically gaslighting us to avoid a crash. That's somewhat what it feels like. Absolutely is what it feels like. Is there a minimum to invest? So the minimum to invest in househack is $25,000 for accredited investors. We are hoping, but I can't guarantee this. We're hoping to get to $5,000 for non-accredited. Although I can't promise that. It could end up being 10. It could be 25. I don't know. I want to make it as accessible as possible to everybody, but it's out of my control at this point. But I'll let you know as soon as we have a certain answer. The hope is to make it very reasonable for people, but it's definitely not going to be less than 5K. Okay, so we answered this question. It was a very good question. Maybe they're factoring in more stimulus. Yeah, unanimity. Oh, I don't think I've ever said that word in my life. All right, short-term chaos equals long-term gains. 5 to 8x gains in 2025. Great time to sell your extra car and get into BTC and hold it. Car for coin. It just happens to match your username. Yes, I do believe that this short-term chaos can set us up for nicer, longer-term gains. I'm not sure and convinced that I would forego the opportunity to invest in great equity opportunities, whether that's real estate or househack or stocks at these depressed levels over a coin. I personally, I'm not sure I would make that decision. I probably wouldn't. But anyway, are houses just going to be in California? No, they're going to be in 3 to 5 different areas throughout the United States, and it'll depend on where we find the best deals, and that'll be where we concentrate. But we want to diversify risk as well, because we want to sell portions of the portfolio while maintaining management and some appreciation to pension funds in the future. So that way we can repeat the process, get more wedge deals, put more into the funnel, so to speak, and spread out keep our IRR, our internal rate of return, as high as possible. Would you buy a personal home now or wait? I would follow the advice of Jerome Powell, and I would wait. I can't give you financial advice, even though I'm becoming a licensed financial advisor. I can't give you financial advice. I'm a real estate broker, so some would argue I'm allowed to give real estate advice. And if I were to give real estate advice, which I'm not going to, but if I were to, I'd be like, don't buy a home right now. Like, don't buy anything right now. I'd be like, just wait. Like, wait. At least wait until the March and April numbers, when we get the year-over-year data, and people are like, oh, crap, real estate's actually falling year-over-year, right? 2 minutes away from JPOW now. Yes. Is there any chance that the Federal Reserve flip-flops just like in 2019? Absolutely. It was actually December of 2018 when they flip-flopped. But yes. It was like December 19th, so I don't blame you. But yes. Would you buy a pro? Okay, so I answered that. How does this change the continued rate increases and balance sheet offloading? I think they're still going to roll off $90 million-ish a month. I don't think that changes roll off at all. Continued rate increases. Right now, we're expecting 75 and 50. It's actually a good point. I'm going to write that down. Yeah, we got the GDP low estimate. And then we also have the path, which is 75 November, 50 December now. The 100 was off the table for a while. I don't know what hangover of ownership. Will there be any overhang of ownership since you were the one starting househack? I don't know what that means. If you're asking me if househack is going to own any of my properties, I sold 85% of my properties, so the expectation right now is no. How can we help you as a realtor or any realtors or service providers? Stay tuned. We're going to be setting up a website for exactly this. So that way in each market that we're considering, there's going to be a way for you to submit your information as an agent or a vendor. We're not close to that at this point, but it will be coming. Yeah, Phoenix is pulling back very hard. I know Open Door is losing money on like over 70% of their listings out there. It's crazy. When do you think used car prices will come back down to normal? Probably, honestly, not until Q1 of next year. Okay, J Pow should be out any moment now. Okay, I don't want to get demonetized for their music. There it is, folks. Woo! I don't know. I get excited about this. I brought sandwiches. I brought coffee. I brought the Diamond Hand coffee. Lauren got me cookies. A course member, by the way, this morning from Dubai suggested that they're going to send us custom cookies, and so I'm really excited about that. These are crumble cake cookies. It's like some viral trend, and of course, Lauren gave me a Halloween plate here. Got the Diamond Hand coffee. Got my sandwiches. I'm ready. Like this. I love this. There he is. All right. Audio's on.
Good afternoon.
No, it's quiet.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year,
It's a V-shape.
well below the median estimate of the longer run normal growth rate.
V-shaped recovery.
Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
What about the quantitative tightening part?
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
Good question.
I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%. and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend, and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of
It's not good.
of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which
Good questions.
the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy?
Good
From
question.
the rate increases. Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today, we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Woo!
Right.
Question.
So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a
Yeah, I thought that was
historical
weird.
perspective, given the expected decline in inflation.
Yeah.
Now, why is that? So really, that is what we generally expect because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Mm-hmm. It's not good how much.
Honesty is still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes,
it's not good.
Vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick Timmeros at the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that, I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting, and talk about it in all of our meetings. And you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve. And that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
Nice.
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here, given there's some discussion now of overdoing it. What's the incentive to continue front loading right now?
Good.
Is it lack of progress on inflation seen in the CPI reports?
I mean,
Or is it a motivation to get as much done while the job market is still as strong as it is?
yeah, it's lack of progress on jobs.
What we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left
There's
open
the
the
debt.
possibility that you might sell mortgage-backed securities, but we've
Yep.
seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus, and you see that I think in the SEP in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward looking and the lags in your policy are forward looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth. And we're seeing that now. So the median forecast, I think this year for among my colleagues and me was 0.2% growth. So that's very slow growth. And then below trend next year, I think the median was 1.2, also well below. So that's a slower, that's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation, and if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will, will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it's very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability. And I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs. And we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control. And that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year expansions. And you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that. We want to act aggressively now and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset and what you think it will take to actually get there.
Good question. I've quoted him many times on that.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There's also longer run issues though with the housing market. As you know, it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
No, I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question. Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation. And, that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get, but what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
Oh, man. Oh, my gosh. Oh, by the way, just to, because I want to bring y'all more live streams because I actually enjoy doing these. I actually installed a coffee machine in this office. Now I can make coffee right here while streaming videos to you live. Got the little Nespresso right there and some fresh coffee. Welcome back, everyone. Let's do a recap of everything that Jerome Powell just told us from his Federal Reserve meeting. And let me tell you, there were some bombshells in this one, some mega bombshells, including, for how long have I been talking about wanting to start this real estate company because I think the housing market's about to go through a mega crash? Jerome Powell literally in this press conference told us that the housing market is about to go through a, quote, difficult correction. Those are declines in excess of 20%. Those are an opportunity for buyers. And my startup, househack.com. Go there to learn more, especially if you're accredited. Okay, let's get into the content of what we need to cover with Jerome Powell. There's a lot. All right, and some of these things are good. Some of them are actually a little bit concerning. So first, we got our 75 basis point hike. Wall Street was expecting 2 dissenters. We actually got 0. That means we had a unanimous 75 basis point hike. The 2 dissenters were actually expected to potentially go for a 50 basis point hike. Wrong. Every single person on the board is expecting a 75 basis point hike. In addition to that, before the summary of economic projections came out, we wrote down estimates of what we thought that the Federal Reserve was going to raise rates to as a terminal rate. The terminal rate is a really important number because it's how high we think interest rates are going to go before the Fed pauses and then eventually U-turns. And on this document, when we covered this live, I wrote down that I thought we were going to see 4.6%. My estimates were in red in 2023 and then 3.9% in 2024. Wall Street thought that the terminal rate would go to 4.1 next year and then 3.6 the year after that. Folks, I nailed both of them. 4.6 on the 2023 terminal rate, that's the upper end of the range I gave, and on the money 3.9 with the estimate that I gave, and that happened live. It was pretty epic. But the reason I wrote those estimates is because I said that I believe the Federal Reserve made a big mistake in June when they gave us their last summary of economic projections. They didn't put on their big boy pants. They needed to put on their pants and spank us a little bit and say, you know what? We just have to be real with you. We need to be more aggressive than we have been. And finally today, the Federal Reserve did that. That made me very happy that the Fed is finally putting on their big boy pants and they're telling us, get ready for a spanking. Now that's good because it does mean the Fed is really serious and they're trying to make sure they build up their credibility as much as possible, that they're serious about getting inflation down. But Jerome Powell gave us a few zingers that really hurt. And I'm not even talking about the housing market zinger. One of the first zingers that Jerome Powell gave us is that in order for inflation to go down, we need to do more for longer, even if inflation expectations are low. Now, that was a shocker for me because I always say that the Fed watches inflation expectations closely, both the market inflation expectations as measured by the 5-year break-even rate, which have been plummeting, and the consumer expectations for inflation, which have also been trending down. Unfortunately, Jerome Powell today said, look, it's great that inflation expectations are low, but the problem is they don't have to stay low. They could jump up really quickly. The best time to get inflation down, though, is while inflation expectations are low. But that means we have to be more aggressive now while inflation expectations are low before higher inflation expectations become entrenched. Now, that's a mouthful, but it was basically a way of saying, yeah, those charts are good, Kevin, but we're going to have to be more aggressive. We have to put the big boy pants on, which I'm actually proud of them for finally doing. This was necessary to finally have a summary of economic projections that was realistic and spoke to America with a sense of realism, not a sense of BS, which we've gotten in the prior summary of economic projections, which in my opinion have been complete trash. Now, this is the summary of economic projections that we have now, and there are a few things to really pay attention to. Number one, change in GDP. The Federal Reserve believes we're going to be as low as 0.2% on GDP for 2022. That is dangerously teetering on the line of a recession. Jerome Powell mentioned the word recession numerous times during his press conference, which in past cycles he has avoided saying. And he says that the longer we have to stay at higher rates and the longer we have to keep raising rates, the less likely it is that we're actually going to have a soft landing at all. In addition, they expect growth to remain below trend for the foreseeable future. In fact, you could see here that growth is not expected to exceed 2% anytime over the next 4 years. The GDP is only expected to be 0.2% in 2022, 1.2% in 2023, until rising to 1.7% in 2024. And even though these estimates are bad, the estimates have always been not as bad as reality. Reality has always been worse than these. Now, something else that's really interesting is the unemployment rate they projected would only go up to about 4.4% next year. And this was one of the other dangerous things that came up in this meeting. The Federal Reserve said in order for them to pause inflationary rate hikes, they would need to see job openings and quits come into balance. If you quit your job, it means you can get another job. And that means you think the labor market is very tight as an employee. Forget about quits for a moment. Let's think about something that's a little easier to understand, job openings. Right now, we have about 2 job openings per 1 job applicant. And the Jerome Powell has told us in prior sessions and prior Fed meetings that we need to see that 2 job openings go down to 1.8, 1.7, 1.5, 1.4, and match 1. So that way we have 1 job opening per applicant. And when we have 1 job opening per applicant, what happens then? Now we have equilibrium in the jobs market, and we actually more permanently bring inflation down. Because right now, even though people's wages are going up, which could lead to an inflationary spiral, a self-fulfilling spiral of prices going up, people are not actually seeing their real income go up because inflation is so high, and that especially hurts the lower income demographics. Like we talked about this morning in my course member live stream, where we try to do fundamental analysis every day the market is open, whether it's on stocks or real estate. We analyzed American Express, and we analyzed what both the CFO and CEO were saying about this Twin Cities approach we're seeing to income demographics, and potentially how American Express could be one of those stocks, along with Tesla, that could actually fare well during an earnings recession because their income cohort, or I should say their customer cohort, has a substantially higher income than other individuals. That's the tale of 2 cities approach that Jamie Dimon over at JP Morgan also echoes. Now, going back to this summary of economic projections, let me just finish that thought. This whole zinger about the having to bring the labor market back into balance is a problem because it hasn't been getting better. Job openings have not been coming down. And that makes me concerned that the Federal Reserve's interest rate policy is actually going to stay restrictive for not just some time, but for some time longer. And the reason for that is they got to bring the labor market into balance. But this is becoming harder and harder by the day. And so far, the numbers aren't actually going down. So this is actually bad news. So it's good news the Fed put on their big boy pants, but it's bad news that they're telling us the numbers that need to go down aren't going down. Sure, inflation expectations are low, but those only matter if the other numbers go down. And since the job numbers aren't going down, that is, job openings aren't going down, we have a problem, and we have to get more restrictive. And that is the defense the Fed uses against anyone who says the Fed might be overdoing it. They just look at the jobs market and go, look at the jobs market, man. That's all we're going to say. Look at the jobs market. It's too strong. That's a summary of the Federal Reserve's opinion on jobs. And it's a very, very critical. Now, the summary of economic projections does foresee that inflation, PCE inflation will go down to about 5.4% by the end of the year. All of these expectations here will probably end up getting missed. They almost always do. The most important thing is that peak of the federal funds rate. I already mentioned this, though, that the Federal Reserve expects the peak to be about 4.6 and then go down to 3.9% next year. Visually, you can take a look at this chart right here. Before the meeting, we had a blue line expectations of what the Fed rate hike would look like. And I warned before the meeting that it's very likely we are going to see rates stay higher for longer, and the market's going to adjust for that. And now the new dot plot represents the white line, and the orange line represents the post-Fed market, which means we're still not aligned with what the dot plot says, which could mean more compression in stocks if the stock market actually cares about the dot plot, which to some degree they should, because the Federal Reserve is pretty unanimous in their decision to raise rates next year. In fact, these top dot plots right here represent a high-end terminal rate of about 4.875. And this right here represents about 4.375. That's 3/8. And you can see that there's an equal distribution of members who are looking at a terminal rate of between 4.375 and 4.875. There's only one person who's voting outside of that range. Otherwise, everyone's pretty consistent that, hey, we need to go pretty strong here on rates. It's not until 2024 that we really see a diversity of opinion in terms of what's going to happen. And what this tells you right here is the Fed has absolutely no freaking idea what's going to happen in 2024. But when it comes to 2023, the Fed understands we're screwed and we need to work harder. Okay? Very, 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 very important. Now, there's some other very important things that the Federal Reserve talked about, specifically in regards to housing. A few months ago, the Federal Reserve told us, I believe it was in June, the Federal Reserve told us, Jerome Powell, they said that if he was a first-time home buyer right now, he would not purchase a home. Instead, he would wait for a pause or a reset. Today, he was asked, what's your definition of a reset? What did you mean when you said that? And he responded and today said that the housing market is out of balance, that people buying homes for 10% over the asking price sight unseen is not a balanced market, that there's a big imbalance and very unsustainable levels of real estate appreciation. Jerome Powell says we need to see supply and demand align again so that way, quote, people can afford a house again. And that, quote, we probably have to go through a correction in the housing market, end quote, which will end up being a, quote, difficult correction, end quote. A correction is defined as an over 20% decline in housing prices. This, in my opinion, folks, is a massive opportunity. I've been warning of this opportunity since January. I sold 85% of my personal real estate between January and the beginning of June. I was already pretty much done in June, but I sold all my real estate in Q1 and Q2 because I'm like, no, we are going to go through the poopers. And that's also why I'm starting this company called Househack, which right now accredited investors can join me in on. Go to househack.com, upload your W-2s, a letter from InvestReady or a CPA or attorney verifying that you're accredited and you can invest with me. You get founder shares and I make not a single dime until your shares double in value and we IPO. And even after that, I'm subject to like an 80% lockup. So like I'm ride or die on this. In the future, we have just retained an attorney to help us file for a Reg A. So in the future, we should be able to accept non-accredited investors as well. But that probably won't be until January. But stay tuned, subscribe to the channel for more updates on that. I believe that either you personally or through Househack, I believe that there are going to be massive opportunities to buy real estate during this difficult housing correction. I believe that what Jerome Powell is talking about is exactly what I've been warning about, that we are going to go through a correction in the housing market. And not only are we going to go through a correction in the housing market, but we're not even close to peak fear yet. Peak fear is probably more likely to visit us somewhere around Q1 to Q2 of 2023, because that's when on a year-over-year basis, we're going to look back and go, oh, dang, the real estate market is getting smoked. So we'll see. It all depends on that 10-year Treasury rate, which is pretty stable right now, around 3.5%, which is a pretty painful level for the real estate market. And if you don't, or you're not interested in investing in Househack, go buy a home yourself when the market softens. Obviously, subscribe to the channel. I'll be talking about exactly when I'm buying, and we'll be having a lot of videos about me traveling and looking for real estate. So you can watch along there. And of course, you could always join the courses on building your wealth link down below, especially that 0 to Millionaire real estate investing course where you learn everything that I know about identifying wedge deals, below market value deals, and making sure you're renovating appropriately. Check those out, link down below. Coupon code expiring in 9 days. Okay, then we had this expectation from Wall Street that the Federal Reserve was really going to BS us again. We didn't get that. We actually got a little bit of a stronger Fed here. The Fed talked about weaker exports, weaker business investments. Talked about gas still being higher and more expensive, even if, compared to last year, even though gas prices have come down. We've talked about, or Jerome Powell talks about core PCE, that's core inflation, being way too high. That if you chart core PCE on a 3, 6, and 12-month basis, core inflation is at 4.8, 4.5, and 4.8%. And that this is not where we want to be. That even though supply side chains being hot have started to cool down, inflation is not coming down enough. And it doesn't matter if the rest of the world is going through this synchronous hike of interest rates. And sure, maybe there's a risk of overdoing it, but the Federal Reserve more importantly risks underdoing it, because if inflation expectations rise while inflation is still hot, the cost of actually bringing inflation down will be much more devastating and much worse to the economy and could potentially even spell economic collapse. This is why Paul Volckered us in the 80s. We want to avoid the devastation from inflation expectations rising, and therefore we need to do everything we can to get inflation expectations down now. And that's why the Fed is acting more aggressively. And this is why the Fed is giving us more dire projections. They want people's wealth to decline. With a wealth effect, as studied by Robert Shiller, who came up with the Case-Shiller index for real estate prices, tells us that most of the wealth effect occurs not from stocks, but from real estate. And in order to really bring down people's impression that they can continue to spend money, they have to essentially cause a correction or force a correction in the housing market. It's not a surprise. And it's exactly what the Federal Reserve has been alluding to for almost a year now. The writing was on the wall. So, bottom line, what's my take on this? Well, I'm finally happy the Federal Reserve gave us a serious dose of reality. The terminal rate is going to be higher for longer. The housing market is going to crash, and stocks are not going to the moon anytime soon. Now, maybe we're going to have another Fed relief rally, which we've had almost every single time after a Fed meeting. We get like a 1 to 2 week relief rally. But that doesn't mean the pain is over. We are still waiting for reports to actually show that inflation is declining. And we now have a big highlighter on the JOLTS report, which even though we knew it was important previously, the biggest highlighter was just drawn on the JOLTS job openings report. And it's scary. So folks, you heard it here first. Thank you so much for watching. Continue to subscribe, be a member, check out the courses, check out househack. If you have questions for househack, make sure to send an email to IR, that's investor relations, IR @househack.com. Thanks so much. Goodbye.